Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at some of the psychological difficulties that people have with letting their profits run and introduced the concept of a trailing stop as one potential method of dealing with this. In today's lesson we're going to continue our discussion on trailing stops with a look at several of the different ways which traders implement these in their strategies. So let's get started.
Okay, so as we spoke about briefly in yesterday's lesson, once a position has begun to move in a trader's favor, many successful traders will manage that position through the use of what is known as a trailing stop. The simplest type of trailing stop is what is known as a fixed trailing stop, and in very simple terms what this means is a stop that moves along behind a position as that position begins to move in the trader's favor, but stays fixed if the position moves against that trader. So basically what you're looking to do here with a trailing stop is to lock in a large portion of the profits the trader has made up to the point where the market reverses and the stop stays in the same position and then eventually stops the trader out of the position before the market moves too far into his or her profits. So as an example here, let's say you've been looking at the chart on the screen here, this trend in euro dollar that started back in August, and we're looking for an opportunity to get into a trade. And based on your analysis, you decided that if the market broke out above this little resistance point here that I've highlighted, that you're going to enter long at 143.60, which is right above that point, and try and ride that trend. So to manage the trade, you're going to place a 100-point trailing stop on this position, which would be at 142.60 since we entered at 143.60. Okay, so if the market moved down to 142.60 from that 143.60 level, then nothing would happen to that stop, and your stop would be elected. At the 142.60 level, and you'd be taken out of the market with a 100-point loss, not including any slippage in commission that may have occurred there. As you can see from this chart, however, the market continued to rally up from the 143.60 point. So basically what's going to happen here is every time the market moves up, that stop at 142.60 is also going to move up so that it's always behind the current market price as long as the current market price is moving in your favor by 100 points. So market moves, market's at 144, then that stop is going to be at 143. But if the market, after the market moves up to 144, if it pulled back to say 143.80, your stop is still going to be at 143 because the trailing stop does not move once the market, it only moves when the market moves in your favor. It does not move when the market moves against you. That's sort of the purpose of it. So with this in mind, once the market topped out here at 1.4752, it did pull back 100 points, so that stop, which would have been at 146.52 when the market hit that high of 147.52, would not have moved backwards as the market pulled back down, and we would have, in this example, been stopped out of this trade at 146.52. Okay, so this is in general how trailing stops work, and most broker platforms will allow you to do this procedure automatically to enter a trailing stop in, so you don't have to do this manually. However, there are some different nuances depending on the market that you're trading and who you're trading with. The trailing stop may work a little differently from broker to broker, from market to market, so make sure you understand the details of the specific market and the specific broker that you're trading with before you try one of these orders out, if you do decide to integrate that in. Now, in addition to the fixed trailing stop, which we've looked at here, there are a couple more that we've looked at the indicators in previous lessons, so I'm not going to go over the charts here, but Another way of doing a trailing stop would be based off of indicators. The parabolic SAR, as I mentioned in last lesson, is a great example of an indicator that was designed by Wells Wilder exactly for this purpose, to, as an indicator to move a stop up as the market moves in your favor. But there are other indicators, or pretty much all of the other indicators that we've studied can be used as a sort of trailing stop, as we've sort of touched on in last lesson. And a great example of this, just like you can use the average true range, or ATR, as we looked at in the lesson on that, to set a fixed stop, you can also use the ATR or any volatility-based indicator to place a trailing stop and sort of keep that trailing stop outside of the market noise. So, you could initially set your fixed stop at 2 ATRs below the current market price, and then maybe trail it up 3 ATRs below, or something along those lines, to keep you safe and outside of the market noise, depending on the strategy there. So you can go back over that ATR lesson if you don't remember that average true range lesson. You should be able to see how you could incorporate that as a trailing stop. Same thing with moving averages. If you plot a moving average on a chart, especially when trading a trend, a lot of traders will use the moving average as their trailing stop. Maybe in conjunction with a fixed stop there, which is a good idea to make sure you always have the fixed stop in as well in that case. Lastly here, some traders will wait until the market hits their profit target before they'll have their entry, they'll have their profit target, and they'll have their hard stop in. Once the market hits their profit target, at that point they will decide to put a trailing stop on to maybe give back just a percentage of their gain that they've had up to their profit target, instead of just taking the trade out at the profit target altogether. But this is just sort of a general overview of the trailing stop there, and the fixed stop and the indicator-based stops is probably the best examples that most traders use there. Okay, so that's our lesson for today. In tomorrow's lesson, we're going to look at another aspect of money management, which is position sizing. So we hope to see you in that lesson. The purpose of the InformedTrades.com community is to hopefully put together a community of traders who will come together and learn without all the hype that's associated with most trading education. So if you haven't done so already, I encourage you not only to visit the InformedTrades.com site, but every page on the site has a comment section, so I encourage you to actively participate in the community by leaving your questions and comments where applicable. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And good luck with your trading.